Central banks control three critical levers: interest rates, money supply, liquidity, through asset purchases and lending programs. When they lower interest rates, borrowing becomes cheaper. Businesses expand. Consumers spend. Asset prices rise. This feels like prosperity. But here's the catch. Cheap money encourages excessive risk-taking. Corporations overleverage. Governments run larger deficits. Investors chase higher returns in speculative assets. The boom phase begins. Low rates for extended periods distort price signals. When money is cheap, real estate prices surge. Stock markets inflate. Debt levels climb rapidly. Growth becomes debt-dependent rather than productivity-driven. Because borrowing is easier than innovation. This creates asset bubbles, valuations disconnected from fundamentals. But bubbles can't expand forever. Eventually inflation rises or asset speculation becomes obvious. Now central banks reverse course. They raise interest rates. Here's the cause and effect chain. Higher rates, debt becomes expensive, highly leveraged borrowers struggle, defaults increase, asset prices fall, markets panic. The same institutions that fueled expansion now trigger contraction. This tightening often reveals weaknesses that were hidden during the easy money phase. 4. Crisis and rescue. When markets fall sharply, central banks step in again. They lower rates, inject liquidity, purchase government bonds, backstop financial institutions. This prevents total collapse. But it also transfers risk. Private losses often become public debt. And during rescues, something interesting happens. Large financial institutions gain access to emergency funding. Small businesses and ordinary savers do not benefit as directly. Asset prices rebound quickly. Those holding financial assets recover faster. 5. Where profit comes in. It's important to clarify, central banks themselves are not private hedge funds seeking quarterly profit. However, the financial system around them can benefit enormously from volatility. Boom phases inflate asset values. Crash phases allow distressed assets to be acquired cheaply. Liquidity injections reflate markets. Those positioned closest to capital flows often gain disproportionately. Meanwhile, inflation erodes purchasing power. Taxpayers absorb increased public debt. Savers lose during low-rate eras. The cycle redistributes wealth. 6. The pattern. Look historically. 1920s credit expansion, Great Depression. Early 2000s low rates, housing bubble, 2008 crisis. Post-2008 quantitative easing, asset inflation. 2020 massive stimulus, inflation spike, aggressive tightening. Each cycle follows a similar structure. Expansion, overleverage, tightening, crisis, rescue, bigger baseline debt. Not necessarily intentional sabotage. But structural incentives that. The money that was never there. Imagine depositing $1,000 into a bank. You believe it sits safely in a vault, waiting for you. But what if I told you that same $1,000 can legally become $10,000 in the economy, without any new physical cash ever being printed? No counterfeiting. No illegal activity. Just a quiet accounting rule. Fractional reserve banking. It sounds technical. Boring, even. But this mechanism is the foundation of modern finance, and it's the reason debt grows faster than money itself. And once you understand how it works, you start seeing why financial crises aren't accidents. They're built into the structure. Setting the stage, goldsmiths and the first illusion. Centuries ago, goldsmiths stored people's gold for safekeeping. Depositors received receipts, claims on their gold. Over time, merchants began trading those receipts instead of the physical metal. It was easier. Safer. Then goldsmiths noticed something important. Not everyone came to claim their gold.